One of the most common questions asked by clients to financial planners is, should I be reducing the risk within my pension as I approach retirement? And on the face of it, this seems to make a lot of sense because over the course of your working life, you've got your paycheck month in, month out. And then all of a sudden you retire and you are fully reliant on your pensions, savings and investments to fund your lifestyle for the rest of your life. But ultimately, what sort of impact can reducing the risk have on your retirement? So in this video, I'm going to be using the software that financial planners use with their clients day in, day out to show you the impact of this on someone's retirement plan. But if you're new here, my name's Ben, and I've worked in financial planning for the last 10 years, helping people build their retirement plans and gain more clarity and confidence around their finances. So if we take someone that's currently age 55 and they're planning to retire at the age of 60. Now, they're currently saving £500 a month into their pension, and when we're building their retirement plan for them, we are assuming a 35-year retirement. And the reason for this is because when we look at ONS data, a 55-year-old male in the UK has about an 18% chance of living to the age of 95. Now, clearly this is unlikely, but when we are building retirement plans, we like to err on the side of caution so that we know if this individual does live longer than the average life expectancy, their retirement plan is still robust and they've got sufficient money to fund their expenses. Now, when we're building retirement plans, we like to use an 85% success rate. And simply what that means is that based on historical market data, in 85 of those last 100 years, this financial plan would have worked. And the reason that this can differ is because depending on when you retired over the last 100 years can have a big impact on how much you can actually withdraw throughout retirement and the pension pot left at the end of retirement. And I've illustrated that here for you. So you can see that if you'd got the 20th best returns out of 100 over the last 100 years, at the end of retirement, you would have had a pension pot of about 1.5 million based on those assumptions. However, if you'd got the 90th best returns, or let's say another way, the 10th worst returns over the last 100 years, you would have just about got to the age of 95 before you run out of money. So when we're building these plans, we like to use the 85th percentile. So we know that by doing this, there is an element of conservatism and caution built into the plan so that even if this individual does get worse returns than average, we know that there's still enough money there to support their expenses throughout retirement. Now, this individual currently has a £300,000 pension pot and £65,000 invested within a stocks and shares ISA, and both of those are invested in a balanced portfolio of 60% equities and 40% bonds. So let's now look at how much they can sustainably spend in retirement and how much of an impact reducing the risk can have on that sustainable spending. So you can see here that assuming a flat level of spending throughout retirement, they could spend about £21,500 a year. Now, the problem with this is that you are unlikely to be spending the same in your 60s as opposed to your 80s. So what I've done is I've assumed there is a 25% reduction in this individual's expenses from the age of 75. And by doing this, this increases the annual spending from £24,000 a year from 60 to 75, and then £18,000 a year from 75 onwards. Now, of course, we also need to factor in the state pension. And for most people, this is £12,500 a year, payable from 67 or 68, depending on your current age. And once this is included, the annual spending increases to £32,000 from 60 to 75, and then £24,000 from 75 onwards. So all of this is assuming they stay invested in a 60% equity and a 40% bond portfolio. So let's now look at reducing the equity percentage in their portfolio, taking a lower level of risk and the impact of this on their sustainable spending. So there you can see the 60-40 we've just gone through and the £32,000 a year spending from the age of 60. So if we reduce the risk slightly, you can see that that spending goes from £32,000 to £30,000 a year. And you can see that by reducing that risk even further, the sustainable spending drops even further to £27,500 a year. And just to complete the picture, I've included two higher risk portfolios and the impact this has on the sustainable spending. So you can see that depending on the level of risk you take within your pension can have an impact on how much you can sustainably withdraw throughout retirement. And the question you've got to ask yourself is it worth an extra £2,000 a year for that higher level of risk within your pension? Is it worth, let's say, a 25% fall in the value of your pension compared to a 17% fall? Is that really going to keep you up at night and cause you stress and anxiety? And is it really worth it for an extra, couple of £100 a month in retirement? That's what you've got to ask yourself. And ultimately, that is not a question that a financial planner can answer for you. That comes down to entirely your own psychology and how you can actually handle that throughout retirement. So the amount you can spend in retirement doesn't change hugely depending on the risk you take. But how about the pension pot left at the end of your retirement? Because this is where things start to get very interesting and where you can see the impact of taking a higher risk within your pension. So all those figures were based on the 85th best returns. But what about if you got the exact median, so the 50th best returns? And you can see that based on that, a 60-40 portfolio would have about £500,000 left at the age of 95 in today's terms. If we then compare that to a 100% equity portfolio, that median increases to 1.7 million. That's over 3 times the pension pot left at the end of your retirement. So although the amount you can spend in retirement is not hugely different, the pension pot left at the end of that retirement, on average, can be hugely different depending on the risk you're taking within your pension. So I'd be really interested to hear from you what you would do, because ultimately this comes down to your psychology. Can you stomach those big temporary losses throughout your retirement? And do you really think it's worth it for an extra £2,000, £3,000, £4,000 a year in retirement? Let me know in the comments below. And if you've got any burning questions you want answered or want me to do a video on in the future, again, please do let me know, because ultimately I want to help as many people as possible gain more clarity around their retirement plan. So again, please do leave that in the comments below. Anyway, hope you've enjoyed the video and got some value from it. If you did, please do subscribe for more videos just like this in the future, and hopefully I'll see you in the next video.